Hey, my name is Nick. So I've been trading for the past decade. I've made millions of dollars trading Forex, crypto, and stocks. And I run a free Telegram channel where a lot of people ask me why I use one-to-one risk-reward ratios. A hallmark of my trading approach is the idea that I don't use positive risk-reward ratios, and instead I just use one-to-one risk-reward ratios. In today's video, I'm going to discuss with you 5 reasons why I do this instead of using 1 to 2, 1 to 5, 1 to 10, things like that. I'll put a link in the description for this free Telegram channel. It's actually a Telegram channel I started 8 years ago in the summer of 2018 just to track my trades, and over time I've just given everyone the link to it, and we've got 50,000 people in here who follow my trades and analysis. But let's go ahead and get into these reasons, and what I'll do is, just in case you're not able to watch the whole video, I'll just show you all the reasons right now. You can screenshot this and then you can go on if you want to, and then if you want to stay for the whole thing so I can break it down in more detail, then fair enough. So here are the 5 reasons. First one is a higher win rate. Number 2, market structure just makes it such that it's easier to get one-to-one risk-reward ratios as compared to higher targets. Number 3 is you can compound your account more consistently because you can actually increase the risk for subsequent trades and grow your account quicker. And there's a lower probability of trades going towards the profit target but then coming back and stopping out at break even or loss. And also, in my opinion, it's much better for psychology and discipline, meaning you can continue to execute the same thing over and over. So let's discuss this higher win rate and smoother equity curve first. Whenever you're using 1 to 2 risk reward ratios or anything higher, we'll use an example here. Let's say the market is coming here to a resistance zone and we think it's going to bounce, right? So it's a resistance zone, we enter a sell. There's a couple ways you can structure this, okay? So the first way you can structure it is you can enter a trade here and you can use a stop loss just above the zone, and you can have a target down here like near the previous low. Right, so in this case, you can have this right here, which is a positive risk to reward ratio. You can also do this right here, which is to say, the same entry, right? Even the same stop loss, but just a 1-to-1 risk reward ratio. Let's break down the mechanics behind this, okay? With a higher win rate and a smoother equity curve, what it does is it does a couple great things for not only your trading account, but also your mindset and psychology. Whenever you have a higher win rate, which should be at least around 50% if you're using a 1-to-1 risk reward ratio, that just means that if you're just entering random 1-to-1 risk reward ratios for any reason at all and just letting trades hit the stop loss or the target, you're going to end up at about a 50% win rate given enough trades. And what that does is that higher win rate will allow you to compound your account once you start getting to be profitable, meaning you can make decisions such as adding to winning trades, holding winning trades longer, cutting the losing trades a little bit quicker, like before they hit the stop loss, such that you can make your average win a little bit more than your average profit. This higher win rate is really big because even if you have a 1 to 2 risk reward ratio, your win rate's usually not going to be around 50%. It might be a little bit below 50%, like say like 35 to 40%. And that's still fine. It's still a profitable approach. But with this, you can still have strings of losing trades in a row. Last week in trading, I lost $150,000. Actually, no, I lost 70,000. No, I lost 50. I lost a lot of money last week. I lost about $50,000 trading. And because of that, what happened is I had a string of losing trades, right? And I'm using 1-to-1 risk reward ratios. Had I been using 1 to 2 or even higher, that losing streak likely would have been much more because the profitable trades that I did have meet the target, they met the targets and then shortly afterwards reversed, thus making it a little bit more difficult to have had a profitable week like ever. And then also it makes it more of a pain in the ass when you have losing streaks because they're usually compounded. So instead of losing like 10 or 20 trades in a row, right, you might lose only like 5 to 10 trades in a row on average, worst case scenario, if you're using 1-to-1s. I do think that using a high win rate really damages a trader's confidence just because if you're using a high, not win rate, but a high risk reward ratio, it just means you're going to have more trades that go towards the stop loss and then trades that you're not able to manage dynamically using your intuition and discretion. And it just causes a lot of like flaws in, I think, a trader's judgment. I prefer 1-to-1s because on top of you having your profit targets easier to hit, which we'll talk about here in a second, it just allows you to have a higher win rate. And I really enjoy that. I enjoy not having to have crazy losing streaks. So the second thing here is that market structure really supports extreme targets. And what I want to do is I'm just going to give you an example of a trade last week that I took that I made $70,000 on. This is a group in Discord where I share all my trades. And so I'm going to show you this right here. This is my P&L for the last 4.5 months. So about $250,000 profit before swaps and commissions. And what I'll do is I'll show you this right here. So this is a GBP NZD trade. This ended up going all the way to where the target was, and it was, I think it was a little over $70,000. So it was, let's see, 50 plus 23. So that was $73,600 that I made just on that trade alone. And this was after a losing streak. And so with that, I want to show you what happened on GBP NZD because I used a 1-to-1 risk reward ratio and what would have happened had I not used a 1-to-1 risk reward ratio. So you can see this trade right here. Let's see, Euro USD, where is the GBP NZD trade? GBP NZD, cool. So here it is right here. You can see I had my entries here. My original stop losses were above the recent highs. It was just a sell at resistance. That's all it was. And then I had added to it as it started to go into profit, ended up going towards the profit target. This is how the trade was structured originally. It was very, very simple. Price came to a daily resistance zone. I entered a sell at that daily resistance zone. I had a stop loss above the zone and then a target down here at a 1-to-1 risk reward ratio. So the trade basically looks something like this. And I risked $50,000 for my first entry. It was a 1-to-1 entry up there, stop loss above and a target down here. If you'll notice is price actually went and hit this profit target last week on Friday, a couple hours before market close. So yeah, like basically like literally right there, just right there at the previous lows where it was at. And then what ended up happening is after that, the weekend occurred, market opened yesterday. Price ended up going up, came back down, and then it bounced up, and now it would almost be back to break even. So this would be a trade that instead of being in $70,000 of profit, it would have come all the way back. My second entry would have been in negative drawdown right now. And my first position would probably be getting out stopped at break even, with my second position being stopped out at a loss. So instead of making $70,000 on this, I probably would have been losing about maybe $20,000 if it keeps going up like over the next few hours. It's really, really valuable whenever you have the idea that you don't have to be a hero to win a trade, right? So the way I look at it, instead of risking, say, $100 on a trade and going for a 1-to-2 risk reward ratio, I prefer to risk $200 on a trade. Right now I'm risking $25,000 to $75,000, but I'm just putting into this in context for you with simple numbers. I'd prefer to risk $200 per trade, use a 1-to-1 risk reward ratio so that if I win, I'd still make $200. However, if I lose, I can usually get out of the trade at break even or a little bit less of a loss. Sometimes the trade's still going to come and hit the stop loss, and that's perfectly fine. That's what stop losses are for. But I use stop losses as just kind of like a worst case scenario emergency type of thing. Meaning I put the stop loss in, and the idea is that I don't want the stop loss to be hit, right? So I'm going to try to exit early if I can based on the price action and context. Using 1-to-1 risk reward ratios gives you that fluidity and that dynamic decision making to be able to use your judgment to close trades early. It gives you that kind of breathing room and flexibility, because volatility can sometimes spike price past zones and then it comes right back into profit. And using tight risk reward ratios with tight stop losses and big risk rewards, that just makes it a lot more difficult to be able to manage things dynamically. You almost have to let the trade just hit the stop loss if you're going to be doing it that way. Using 1-to-1s in this case, I had my profit target hit. I made $70,000 and now I'm on to the next trade. So I prefer to risk a little bit more money, or in my case, substantially more money, and using a 1-to-1 risk reward ratio as compared to risking a lower amount of money and using a high risk reward ratio. You just have fewer losing streaks. You have a higher win rate. It's easier on psychology and mindset, in my opinion. And you also have fewer instances of price trying to go into profit and then coming all the way back because it didn't hit your, say 1-to-2 risk to reward ratio. So that is the second reason. So what we'll do is we'll go back up here and we'll cover these last three reasons. That way it can give you more of the context. So go here to the daily. So the third one is more consistent compounding. This one, I don't even have to show you an example on the charts because it's basically a math defense of this. So more consistent compounding, look at it this way. If you're going to be trying to compound your account, what that means is as your account grows, you start risking higher dollar amounts. And it could be the same percentage, right? So if you start risking, say, 10% of a $1,000 account, that's $100 per trade. Well, let's say you grow the account to $2,000, but you're still risking 10%. Even though the percentages stay the same, the dollar amount you're risking is now $200 on a $2,000 account, 10% of the account. And you're able to do this in a lot more linear of a way with less kind of volatility spikes in your equity curve as it hopefully goes up and to the right. You're able to do this way better and way more consistently with a 1-to-1 risk reward ratio as compared to having to brave the storm and fight in the trenches of using like a 1-to-2 or a 1-to-5 or, God forbid, an even higher risk to reward ratio. With more consistent compounding, what it can do is it allows you to be able to allocate more risk to trades that are higher quality, knowing that you don't have to be a hero and catch the next crazy move of like a 1-to-10 risk reward ratio to be able to make any money. you have less losses, you have way more wins. You're not trying to, quote, be a hero and trying to catch the next big crazy move. You're trying to just catch the small consistent moves where price just bounces away from the major support resistance levels of a zone. And I find this so much more easy and consistent to compound, just because it allows you to be able to continue to scale up your risk in terms of dollar amounts, even if you keep the percentage risk the same. And that, in my opinion, and in my experience, having done this myself for years and also having taught like over 4,600 clients how to do this, I find it's a way more consistent way of growing your account in an actual way where it's like, you can call it compounding. It's an actual, you're not growing a $100 account, only $20 profit for the whole year, right? That's 20% gain. That's great. But most people, whenever you're trading something like Forex, you're not looking to get S&P 500 returns. You'd like to kind of outpace the market. And you're only able to do that with higher risk. And you can add that higher risk to compounding. And it's easier to do with a 1-to-1 risk reward ratio than a 1-to-2 or higher. Number 4, there's a lower probability of almost winning. So this kind of plays into number 2. But this idea is that the lower probability of almost winning means that whenever you buy, say, at a support zone, which, for example, I'm long on GBP CAD right now, right? These are my 2 trades I'm in. I'm in a USD/JPY short and a GBP CAD long right now. So, right, this GBP CAD trade has a $50,000 profit target. And this one is, it's if I win, it'll be a $50,000 profit, and that would be super, super nice. And the reason here that I say that there's a lower probability of almost winning is because if you're just using 1-to-1 risk reward ratios, whenever price does start moving into profit, you'll generally get your targets hit pretty easily, right? Meaning, like, if you enter a trade, price just has to bounce off the zone and go into a nice significant profit. And if it goes into a significant profit of just 1-to-1 risk reward ratio, those targets are way more easy to hit, right? So you have less chance of, let's say you target the highs up here and it's over a 1-to-2 risk reward ratio. You have something like this where it can go up, comes all the way back. This takes like a week and now you're still at break even. Then it tries to go up here and then it reaches really high, almost hits the highs, then it drops all the way back. I don't like having long trade durations, and I don't like having trades that almost win, right? They almost went to the profit target, or they went to significant profit, and then God forbid you added to it, and then it comes back, and then it's a break even on your, on your initial trade, and your second entry that you added is now sitting in a loss, and you have to close it. And what could have been a nice winning trade, had you just risked the higher dollar amount and taken the smaller, more predictable move of just a 1-to-1 risk reward ratio, you're now having trades almost hit your profit target and then immediately reversing. I don't like that. I don't prefer that to be the case. And so in my opinion, 1-to-1 risk reward ratios just works way better for me. So closing it up here in the last part, I think it's better for psychology and discipline. This kind of ties together the previous 4 things. Whenever you're trading, you'll notice that one of the biggest detriments to your confidence is just losing streaks, right? So just losing a couple trades in a row, whether that's 2, 3, 4, 5 trades in a row. That can cause a lot of people to go really, really crazy. However, if you're using a 1-to-1 risk reward ratio, it's very likely that regularly you're going to be having winning trades, right? Because again, even if you just blindfold yourself and enter random trades with 1-to-1 risk reward ratio and no dynamic management, meaning no closing losing trades early, no adding to winning trades, nothing like that. You just blindfold yourself, enter 1-to-1 risk reward ratio trades and let it hit stop or target. You're already ahead of 90% of traders, because 90% of traders lose money. If you do that, you're going to roughly break even net of fees and commissions and swaps, right? Because if you enter 1-to-1, half the time it'll go to the profit target, the other half the time it'll go to the stop loss. So guess what? In terms of being a better for psychology and discipline, you are starting out with a trading approach in which you're, I don't want to say guaranteed to not lose money, because you can't guarantee anything in trading. Trading's risky, and the fact is that most people lose money. It's really hard. It's really difficult to do. And so I think it's better for psychology and discipline, because you know that at least half the time, roughly on average, given enough trades, price will hit the profit target. That's a great place to start, especially for a beginner. If you're in a position where you're not yet profitable, I'd say, you're beginner if you're not profitable, you're intermediate if you are somewhat break even, and then you are, I don't know if I'd say expert, but you're doing very well if you can make any significant amount of profit over the course of like a 6 to 12 month period. Whenever you're doing that, 1-to-1 risk reward ratios enable you to do that much, much easier. And it's way easier on your psychology, because whenever you start with 1-to-1 risk reward ratios and just let it play out, if you can just start closing losing trades a little earlier and then holding winning trades to the profit target, and then in some cases adding to winning trades if the context makes sense, then what you can do is you can start making a little more than you lose long term. Using 1-to-1 risk reward ratios gives you not only the freedom and dynamics to be able to manage those things and get out of losing trades early and hold winning trades longer, but it also allows you to have way more wins because you know that the next win is just right around the corner, instead of having to think like, man, I've lost 5 trades in a row and I'm using a 1-to-5 risk reward ratio. And so the likelihood of the next trade hitting that 1-to-5 risk reward ratio, and then the amount of time it's going to take to actually go all the way there, that can be very unnerving to a lot of people. And like, I don't personally like doing that. I've been trading literally like in 5 days from now, it will be exactly 1 decade since I've been trading. I've not found anything else more easy and more simple than just using a 1-to-1 risk reward ratio. And part of the reason it's so easy is because, in my opinion, I have to say this subjectively, but I think it's objectively true, that it is better for psychology and discipline if you're using a 1-to-1 risk reward ratio, because you can manage losing trades by getting out of them early, and then you can hold winning trades longer, thus increasing your average win, making it bigger than your average loss, so that even with a 50% success rate, you're still net profitable. That is something that's so, so beautiful. So because of these things, I think a 1-to-1 risk reward ratio is definitely the way to go. You're free to experiment it. You're free to experiment with it for yourself. You're free to follow my trades here in Telegram to, kind of like watch me apply this every day. I share basically all my trades and analysis in here, and it's free. It's just a free resource I run here in addition to my YouTube channel to be able to help you learn how to trade. So I hope this video was helpful. Go test this out for yourself. Let me know what you think below in the comments. Cheers.